All right, today we're digging into a really fascinating investment report on one of India's true titans, Tata Consultancy Services. We're talking about a massive $110 billion company. But as this report points out, there's a real puzzle right at its heart. So let's get into it.
So right off the bat, here's the core question this whole report is built around. And it's a real head-scratcher because it kind of goes against everything we think we know about how markets are supposed to work. How can a company be making more money year after year while its stock price is actually falling? It just doesn't seem to add up, right?
And what makes this puzzle even weirder is the report's final verdict. I mean, they put it right up front, accumulate. So even with that falling stock price, the analysts are basically saying, hey, this is a buying opportunity. And they're not just guessing. They're giving it medium to high confidence over the next 3 to 5 years. So yeah, the plot definitely thickens.
Okay, so let's start by really unpacking this core contradiction. What does the data in this report actually show us? Let's look at the numbers. And wow, when you see it side by side like this, the difference is just stark. The report's data shows that over the last 3 years, TCS's profits have been chugging along, growing at a really solid 8% a year. But at the same time, the stock price has gone in the complete opposite direction, dropping by an average of 8% every single year. The business is getting bigger, but the stock itself is shrinking. It's a total disconnect.
Now, there's a technical term for this, and the report calls it PE de-rating. It sounds complicated, but it's actually a pretty simple idea. All it means is that the market has changed its mind about what TCS is worth. Think of it this way. A few years ago, investors are willing to pay, say, $30 for every single dollar of profit TCS made. But now, they're only willing to pay around $18 for that same dollar of profit. The earnings are still there, but the opinion, the sentiment around those earnings has totally soured.
Okay, so before we figure out why everyone's so down on this stock, the report makes a point to first look at the business itself. And what it finds is that this thing is, well, it's a financial fortress. It's built on a rock-solid foundation. First up, just look at this number, 64.6%. That's its return on capital employed. Now, in simple terms, that means for every $100 TCS plows back into the business, for new offices, new tech, whatever, it generates nearly $65 in pure profit. The report says this is one of the best in the entire Indian market. It's just an incredibly efficient money-making machine. And then there's the safety aspect. Check this out. Its debt-to-equity ratio is just 0.10x. And the report even points out that this isn't really borrowing debt in the traditional sense. It's mostly accounting stuff like office leases. So for a company of this enormous size, it's pretty much debt-free. It has incredible stability because it doesn't owe anyone a thing. So what does TCS do with all that cash it's making? Well, it gives it back to its owners, the shareholders. Over just the last 5 years, they've returned a mind-boggling 173,000 crore rupees. That's over $20 billion through dividends and stock buybacks. The report calls this extraordinary capital discipline. They basically make a ton of money, and they give almost all of it back. It's impressive. So the question is, how is all this financial strength protected? Well, the report uses that classic term, a wide business moat. And it says TCS has 4 big things protecting it. First, high switching costs. Think about it. Over 600 banks use its core software. Tearing that out and replacing it, it's almost impossible. Second, massive cost advantages because of its India-based delivery model. Third, the Tata brand itself. That name just screams trust. And finally, just sheer, unbelievable scale. With over 600,000 employees, they can take on gigantic projects that almost nobody else on the planet can handle. So that brings us right back to the central paradox, doesn't it? If the business is this debt-free, high-return, cash-gushing fortress with a huge moat around it, then why on earth is the stock doing so poorly? This timeline from the report really tells the whole story. Just a few years ago, back in its high-growth days, the market was happy to pay anywhere from 28 to 38 times its earnings for the stock. But then, as growth started to slow down, you could see that multiple just getting squeezed. And today? It's sitting at 18.1 times earnings. The report calls this a decade-low valuation for the company. The market's perception has just completely flipped. All right, so let's get into the nitty-gritty. What are the specific fears that are causing this massive derating? The report points to a few key things that are clearly spooking the market. First off, the report highlights this changing of the guard in who actually owns the stock. You can see that foreign institutional investors, the FIIs, have been selling pretty consistently.
Their stake dropped from almost 13% down to just over 10% in only 2 years. But here's the interesting part. Look who's buying what they're selling. It's the domestic institutions, the DIIs. They've been snapping up those shares, increasing their own stake. The report kind of frames this as a vote of confidence from patient local investors who maybe see the long-term picture more clearly.
So, why are the foreign investors selling? Well, the report lays out the main worries. Number one, revenue growth has really slowed down. It's just around 3% right now. That's a big change. Number two, something called debtor days are ticking up. That's just the time it takes for clients to pay their bills, and when that number goes up, it can be a red flag. And then there's the big one, the elephant in the room, the threat of AI. There's a real fear that artificial intelligence could completely upend its entire business model. These are the dark clouds that are really hanging over the stock right now.
But here's where the report pivots. It argues that this exact combination, a fortress-like business on one hand and these very real market fears on the other, has created a unique opening. It's not a problem, it's what they call an asymmetric opportunity.
And this comparison table really drives the point home. Look at this. TCS trades at a valuation of about 18 times earnings. That's way cheaper than the sector median of 22. But then look at the quality metrics. Its ROCE and profitability are far superior to its peers. The report literally calls this discount anomalous. You've got the best-in-class company trading at a bargain price. It just doesn't quite add up.
And this is such a crucial point the report makes. The company has a free cash flow yield of about 5%. The simplest way to think about this is like getting a 5% cash rebate on your purchase price every single year. For every $100 you invest in the company at today's price, the business itself generates $5 in pure, cold, hard cash for you. It's like you're literally getting paid to wait for the market to change its mind. And this bar chart really visualizes the whole risk-reward situation. In their worst-case bear scenario, they see a potential downside of only about 6%. But look at the other side. In their base case, the expected upside is 26%. And in their optimistic bull case, it's a massive 64% gain. The potential for profit just massively outweighs the potential for loss. I mean, that's the textbook definition of an asymmetric bet. And honestly, this one quote from the report just sums up the entire investment thesis perfectly. The gap is the opportunity. Earnings power is intact. Only the multiple has compressed. The whole argument is that nothing is fundamentally broken with the company's ability to make money. It's just the price tag, the market's perception of it, that's shrunk for now. So we end up right back where we started with this incredible tension. On one side, you have this detailed report laying out the case for a financial fortress, a truly best-in-class company that's on sale at a historic discount. But on the other side, you have the market, which clearly sees a company with slowing growth and a business model that's under threat from AI. So the big question this report leaves us with is, who's right?